So if you think your credit score is what decides whether you'll get approved for a home, you're already playing by the wrong rules. Because the system that decides who gets approved just changed, and most buyers don't even realize it yet. If you don't keep up with lending rules and how they change over time to get a mortgage, make sure you watch this entire video so you get the full breakdown of the changes that have been made recently by Fannie Mae and others. And if you're still waiting on rates or prices to move, you could be missing the shift that actually decides this outcome. Let me start with something that could directly affect whether you ever get approved for a home, and almost nobody is talking about it. See, the housing market can change without prices falling, it can change without mortgage rates dropping, and it can change without a crash. Because the most important changes don't always show up on Zillow. They happen inside the system that decides who is allowed or able to buy and who quietly gets filtered out of this process. And that system just changed. Not in a way that made headlines and not in a way that feels dramatic, but in a way that could determine whether you get approved or have to keep waiting over the next several years. See, right now, buyers are obsessing over interest rates, others are waiting for prices to fall, and some are holding out for a big reset of the housing market. But almost nobody is watching this one thing that actually can decide this outcome for you personally. And that is the rules that determine who qualifies to get a mortgage. See, those rules are being rewritten quietly right now. This is the mortgage credit reset. So why does this matter more than rates? See, when people talk about housing, almost every conversation collapses into two numbers: home prices and mortgage rates. Those do matter a lot, but neither of those decide whether you are actually allowed to buy. Your credit history does. Credit has been the gatekeeper for the longest time because you can have a solid income, a stable job, years of savings, and a responsible budget and still be denied a mortgage in some cases. Not because the payment doesn't work, but because the system doesn't recognize you as a safe borrower. Here's the disconnect most buyers don't realize. Rates and prices affect how expensive a home is, but credit determines whether you're allowed to compete at all. Your credit also determines how high of an interest rate you pay. So whether you have a prime interest rate or you have to pay more if your credit is a little bit worse. See, a rate cut doesn't help someone who's denied a mortgage. A price drop doesn't help someone who can't get approved. Credit is the permission slip. This has real-world impact. Here's what that looks like in real life. Two buyers walk into the same open house, the same price, the same neighborhood, the same mortgage rate in most cases. One gets approved in weeks, the other never gets a chance to compete. From the outside, that can look confusing. Both may earn similar incomes, both may have savings accounts, and both may be financially responsible, but the difference isn't affordability, it's qualifications. That's why so many buyers feel like the market is broken. They're not wrong, but they're often looking in the wrong place. The market isn't rejecting them because prices are too high. It's rejecting them because the system doesn't know how to classify them. And classification matters more than intention. You can want to buy a home more than anything. You can be ready emotionally, financially, and practically. But without approval, none of that matters. That's why credit, not rates, can be the real choke point for some buyers. And when the choke point moves, the entire market behavior moves with it. For decades, that permission came from a blunt tool, a single credit score, pulled at one moment in time, weighted heavily towards past mistakes. Did you miss a payment years ago? That follows you. Do you have short financial setbacks? That can follow you too. Meanwhile, what you're doing right now, paying bills consistently, managing cash responsibly, staying employed, often matters less than it should. The system was built to avoid risk at scale, not understand nuance. And today, That creates a growing disconnect. People look stable in their life, but risky on paper. That disconnect is what's finally being addressed with these new rules. What the mortgage credit reset actually is. So let's be clear about what this is and what it isn't. This is not a 2008 style loosening. It's not a giveaway, it's a modernization. For a long time, lenders relied on credit models built for a simpler financial world, one where most people had W-2 jobs, credit cards were the primary signal, and income and debt followed predictable patterns. That world doesn't exist anymore. Today's buyers include gig and self-employed workers, people who intentionally avoid debt, buyers with strong income but thin credit files, younger buyers early in their careers. The old system wasn't designed to ask the question, is this person financially stable today? It asks, do they resemble past borrowers who didn't default? That distinction matters. The mortgage credit reset changes how risk is evaluated, not whether risk exists. Instead of relying on a single snapshot score, newer models emphasize payment consistency, behavioral trends, and long-term patterns. Think of it like this. The old system judged health based on one doctor's visit from years ago. The new system looks at the timeline. That doesn't lower standards. In many cases, it raises them, just in different places. Buyers who were stretched thin but look clean stand out more clearly. Buyers who made a mistake years ago but have been stable since finally look like what they are. Stable. This reset doesn't make housing easier, it makes it selective in a different way. So why is this happening now? To understand why this change is happening now, you have to look at it from the lender's side. Banks don't care about headlines. They care about default risk. And over the last decade, the data started telling a different story. Some borrowers with high credit scores were struggling, not because they were irresponsible, but because they were stretched thin. At the same time, other borrowers with lower or thinner credit profiles were performing extremely well. They paid their rent on time, they paid utilities on time, they avoided over-leverage, and they managed cash conservatively. But the old models treated them as unknowns, so lenders were missing real signals and mispricing risk. This reset isn't about generosity, it's about accuracy. And when risk is measured more accurately, access shifts. That's why this isn't temporary, it's structural. So how the rules are changing right now. This isn't theoretical, it's already happening. Credit scoring is evolving. Fannie Mae has removed a hard minimum FICO score requirement for conventional loans. Scores still matter, but they're no longer a single pass-fail gate. Newer models like FICO 10T and VantageScore 4.0 incorporate rent payments, utility history, and consistency over time. That matters because rent is often someone's largest monthly obligation, and historically, it counted for almost nothing. Now, behavior matters more than strategy. Next up, employment verification is tighter. Job changes, relocations, and remote work now require more proof. Lenders are now more strict on having signed offer letters, confirmed start dates at new jobs, and proof of permanent remote status. This reflects a broader shift. Not have you always done this, but can you sustain this? So now moving on, why buyers are feeling blindsided by this. This is why so many buyers feel blindsided when approval doesn't go the way they expect. They did what they were told, they watched rates, they saved for a down payment, they worked on their credit score, but they didn't prepare for documentation intensity. They didn't anticipate how closely income stability would be examined. They didn't realize job changes would matter more. They didn't expect remote work to need explicit verification. So when approval stalls, It feels sudden, but it's not sudden. It's the system asking different questions. So what does this mean for borrowers? Some buyers quietly gain access to mortgages. Others face more scrutiny, and many buyers feel confused because nothing visible changed. No crash, no headline, no dramatic signal, just different outcomes. Which is why focusing only on interest rates misses the real shift. But this must help some, right? This reset doesn't help everyone equally, but it improves the odds for buyers that the old system misunderstood. Buyers with thin credit but strong habits, buyers with past setbacks and consistent recovery, young buyers early in their earning curve, self-employed buyers with repeatable income, or cash-disciplined buyers focused on sustainability. The common thread isn't perfection, it's consistency. What may be most important is who doesn't this help. This reset does not reward score-only optimizations, over-leverage, or static assumptions. Perfect credit without resilience is no longer enough, and buyers who assume qualification rules are frozen in time are the most exposed. Housing punishes complacency. So with all of these changes that are being made to qualifying for a mortgage, why won't this fix the housing market? See, this reset does not make housing cheaper. It does not build homes. It does not fix supply issues. It reallocates demand. Think of it like changing the door policy to a crowded room. The room stays full, the guest list changes. Some buyers gain access, others face more scrutiny. Competition doesn't disappear, it just reshuffles. The housing market is shifting away from being defined purely by price and toward being defined by access. Two buyers can look identical on paper and have very different outcomes, not because of rates, but because of how the system evaluates them. That's why buyers feel stuck even as headlines improve. The bottleneck isn't price, it's permission. Markets don't just move on prices, they move on rules as well. And rules change behavior long before prices respond. When access shifts, buyers just adapt. When buyers adapt, competition reshapes. When competition reshapes, outcomes change, even if nothing looks different on the surface. By the time it feels obvious, the sorting has already happened. That's what makes this moment dangerous for passive buyers and powerful for informed ones. Housing markets don't reset all at once, they resort quietly, structurally. The next housing shift won't look dramatic, but it will change who gets a chance. And understanding that now is one of the most valuable advantages a buyer can have.